Alright, welcome everyone to the next installment of Engineering and Investment. I'm your host, Austin, and let's get started. I'm a little bit later this weekend. I've been traveling, but I look to do this weekly. So today we're going to start with a suggestion from the comment section of the last video. So if you have suggestions or things you want me to look at, make sure you put it in the chat or comment after it's done, and I'll take a look at it next time. So in the chat, someone saw that there was Churchill Downs, the horse racing track, appeared in the screener for last time. So that's where I wanted to start this week, because we had some interest. So as we can see here, it's a decent looking chart off the start, and we can so those who don't know, Churchill Downs is a famous horse racing track. So we can see that the normal PE, so the average, usually trades at on average a 27 PE, but it's fallen quite a bit below that, which normal it's looking historically like fair value around 16%, but that's so let's take off the normal and see what it looks like from this chart. That the share price is coming in line with what fair value ought to be, but let's take a look at forecasting and see what we're looking at here. So we would, if it maintains a 15 PE, which would be the growth rate or the fair value, we'd be looking at the presented growth rates here of 3%, then 14.5%, then 4.5%, and then very low growth a couple years out. We'd be looking at almost 10% per year. If it went up to its more favorable or a more expanded valuation, we could see your return be higher, somewhere like if it traded at like 18 PE, we could get up to 18% year over year. Or, I mean, take your pick here, 16 PE, we could be anywhere like 14%. So there's a chance this could hit within the range that we're looking to get of 15 to 20%, but it's you'd have to get the market to start putting a premium back on the stock, which has happened in the past, and it's one of those famous stocks that you want to buy it just because you want to say you own a piece of Churchill Downs, not because maybe not necessarily because of the outperformance of the company. So they do have a little tiny dividend. Their value total at 16 billion in market cap. So let's take a look at how well the analysts do. So they Churchill Downs typically beats the early estimates, and then it's more of a 50-50 longer term, or at least with 1 year forward, and then 2 years forward with 20% margin. The analysts can get within 20% 2 years out. So we're going and looking at 2 years out, 2028. The analysts can usually get this number within 20% pretty well. So I think with that, and it's an established company, so I think you can these estimates could be fairly in line. They're not too outlandish. With that being said, if you're interested in owning Churchill Downs as a part of horse racing, and because you're really into that scene, it could still be a decent investment too. So we could check out Fast Graphs and look at a normal multiple and go like 10-year average. I like to use 10 years. There's not much difference between 10 and 5. So I mean, if it goes all the way up to it, the market puts a premium on it, we could see it expand. It's just been It's not been favored by the market right now. They haven't been. It's been beaten down. So it could be a decent investment if you think the premium is going to come back. Which you like to, when you're looking at this kind of chart, you like to see the earnings just climbing, 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 and the share price underneath the orange line. That's a positive looking chart. I don't really see horse racing going away with how popular sports betting is and gambling just in general. Horse racing could gain in popularity, really. So with that being said, I think that covers Churchill Downs for us. If you want to know more about it, you could go to the corporate website. But those who are interested already know about it, and those who aren't interested probably don't care. So with that, another suggestion I got to look at was looking into the software space, because they've all taken a beating from the AI fears. So ServiceNow is one of those companies that's really gotten crushed. As you can see here, it was peaking around 200 a share, and it's really come down to under 100 a share. It's got a really beautiful earnings curve, just a nice exponential gain. Market always puts a premium on these software stocks. So part of the reason that software always had a premium valuation above its growth rate was it's capital light and it's really easy to project. You'd project the software as a service, you could project the revenue and the number of seats and things like that. So this is probably a good time to talk about what ServiceNow is. So as I was saying, they're a software provider, and anybody that has a desk job that works for a company that gets IT emails or automated emails at their work, ServiceNow is a business-to-business software offer that does like IT tickets and things of that nature, anything automated that the company wants to send to all of its employees. So I see lots of ServiceNow at my current job. Anytime IT wants to open or close a ticket, or HR or something like that. So I know it's around. So the biggest question with these software companies is are the AI fears overblown, or is this a good buy area? So we got, so there's three ranges for what the software companies. This is the first time I've seen this on. This must be a new FAST Graphs feature here. So the analysts have it growing a lot over the next few years, but if you bought it now and it only matched the growth rate, you'd be getting a 12% growth return year over year, which that's not bad, and you're probably taking. You're probably buying it at a decent spot, because a lot of the fear is already baked in at this point. We haven't seen any of the AI fears materialize yet. The fear of prices going down or people creating competitors it's not really materialized yet. So that's the kind of risk you'd be taking if you were to buy one of these software companies. I think it's a high quality company. I don't see ServiceNow and how well it's entrenched within a lot of businesses. I don't see it really going away. What could happen to them is competitors could start forming, like the cost with AI, the cost of software has gone down. So therefore their moat got a little smaller, and therefore more competition could pop up, and it could lower the prices that ServiceNow can charge. So we might not see the growth rates. There we go. How this has been changing is the analysts really have no way to project. The current's actually higher than it was 6 months ago, so they must have had some good news. If we look at how well the analysts do at predicting. They continually beat on earnings. So I think this looks like a really high quality company. Full disclosure, I don't own any yet, but this looks like a really high quality company, and I might look into this further and do further research and see how it fits in with the rest of my portfolio. I'm just gonna add this to my watch list. I really like the Fast Graphs app. If they ever want to sponsor me for doing these videos, because I think that'd be really cool, because I think it's a great app, and hopefully everybody watching thinks it's a great app too. So they're valued almost at 100 billion. If they have a really good day, they'll probably go up to 100 billion on Monday. Markets were closed Friday for federal holiday, so this is updated per official close on Juneteenth, or the day before Juneteenth. So this, it's still, I think at this point, if you can get it for a little cheaper, I think that'd be the most ideal situation. However, at these prices, it looks relatively fairly valued. You would need some outperformance on the earnings, or maybe the multiple to go back to expanding and see the market put a premium back on software in order to see greater than the 15 to 20% return. So right now, if it just stays the course and you even get a multiple contraction to what its growth rate should be, you'll only get like 12%, which 12% is good, but it's not quite the goal. So Tyler is another software company that I wanted to stick with some software theme. So let's pull up the historical chart here. As you can see, the market has put a massive premium on Tyler over the years. 53 normal PE. That is absolutely crazy. So, and as you can see, we've absolutely fallen off going towards this orange line. If we take off the orange line to look at, I thought maybe it would adjust the graph a little more. The earnings, it's a solid trend up, but it's not like a crazy growth story. I'll talk about what this company does. So they do all your government software. So anytime you use a local government's portal or website or app or things of that nature, you go to pay your water bill and they got a portal. Tyler is probably the software company behind it. Anytime you want to pay your state tax or get your state tax return, and there's a portal with that, it was probably Tyler that did it. So it's a very entrenched company, and I would say that the AI risk is even less for that because the government's really slow to change off of something that works like that. So, and they're not going to have employees that can create their own internal apps that do it. They're just going to contract it out. So if we go to forecasting, we're not seeing huge growth rates, right? So we see these are good growth rates, but they're growth rates at that would normally be valued at 15 PE fair value. But as we know, this software company tends to get a premium. So if it goes back down to a 15 PE, even with all this earnings growth, then you're still going to have a net negative return. If you're investing in this, you're really hoping for multiple expansion for it to go back to its premium status. So let's see how the analysts do. They're awful current short term, and they're pretty good 1 year out, and they're pretty good 2 years out. So I wonder why they're so bad currently. But see, so it looks awful just based on that. But if we go to its normal multiple and look at a 10-year 54 PE, I mean, if it gets back to that, you'd be making a killing on your investment. It could go back up to, you could be looking at 60% year over year. if it with the same earnings growth, say it goes up to you would need it essentially to get to a 27 PE to start getting from its current. If these earnings hold, essentially, these earnings hold, which the AI fear is why this stock is. People aren't sure that these estimates are going to hold. That's why. That's the fear of the AI coming to eat software's lunch. So, which I don't know. I don't think AI is going to threaten software. I think it's going to threaten software to an extent, but it's not at a level that replaces software engineers that any Joe Schmo can create an app with the layers of security and good architecture and things of that nature. So competitors just can't pop up out of nowhere, but it definitely does decrease the cost of code. So as a layman who's used it to vibe code lots of apps, not apps per se, Python scripts to do data analysis, you can say that it would lower the cost of code. So 20. I think for me, this stock, I think it needs to fall some more for me to buy it, to have a margin of safety. I don't like relying on, I need this stock to be overvalued for me to make money on it, or I need this stock to be valued at a premium and the market needs to put a premium, and that's how I'm going to make my money. I mean, that works for a lot of people, and the market does put a premium on things. Like, as you can see, this traded at a 54 PE for the longest time. Now that it's lost its luster, I'm not sure it's going to go back to those days. But it wouldn't be out of the question to see like a 25 PE. Like, that's where it's at currently. So if it just maintained that PE, you're getting a good return. So this would be, I would consider it high risk, high reward. With that being said, let's move along nicely. So another request I got was Coinbase. Coinbase is, those who don't know, it's a crypto trading platform. So fun fact, I got in Coinbase early on the IPO, lost some money, came back, exited it because I was already pretty heavily exposed to crypto, so I didn't think I needed to be exposed with my stock trading too. But and I haven't looked at it since I got this request. So its normal multiple is going to be all over the place because it really hasn't made a profit and it hasn't been around for that long. It's heavily correlated to the price of Bitcoin because the more trades that happen and the higher the price of Bitcoin is, the better this stock does. So as we can see, it's very cyclical, and it's currently in a down cycle with the price of Bitcoin being a lot lower. These PE ratios are very skewed because of this giant growth rate right here. Because what happens is that this app averages the growth rates across these and then puts PEs based on the growth rate. So based on this, if you wanted to wait to get a 26 PE, which you would look at 4% year-over-year growth based on these estimates. So the analysts are expecting a heavy downdraft on Coinbase's earnings. I think we're here at crypto winter. Bitcoin, I think Bitcoin's going lower. I don't think the bear market's over. Coinbase has a good habit of beating the analysts' expectations, so these numbers could be higher because Coinbase beats a lot. So, take these with a grain of salt. It's crazy. Well, it's traded at 141 because it's had such low earnings that when you divide by the low earnings, you get a huge number. So, Yeah, that's a funny looking graph. So here, let me explain how the Bitcoin cycle could come to an end. Uh, who has heard of stretch or MicroStrategy? So MicroStrategy is the company owned by Michael Saylor. They issue debt and they buy Bitcoin, and then when the price of Bitcoin goes up, they issue more debt and buy more Bitcoin. So that's just what they do. And so they released this new product. It's basically a leveraged way to buy Bitcoin. This is what this stock is. And it goes hand in hand with Coinbase because they're tied to Bitcoin directly. So what Michael Saylor has done, let's see if Michael Saylor stretch Bitcoin product. Let's see if stretch comes up. Okay, STRC. I wonder if Fast Graph has that. It's pretty new. No, okay, Fast Graphs doesn't have it yet. If we... So, what MicroStrategy has done is issued this new product called Stretch. And he basically said that if you buy this, it's going to be pegged at $100 par. Oh, there's a fly. I got it. Got it. Sayonara, fly. So what Stretch does is they said it was going to be pegged at $100 par, and then if it starts trading less than $100, then they're going to raise the dividend. And okay, there's too much going on this page. It's slowing everything down. All right, we are leaving Investopedia. Well, while this is taking forever, so they were going to peg it to $100 and issue a bigger dividend if it ever goes lower than $100 in order to entice more people to buy it, to bid it back up to $100. And it's currently trading, I think, low 80s, and they haven't raised the dividend yet because in order for them to pay the dividend on it, they have to sell Bitcoin to raise the cash to pay the dividend. If they sell Bitcoin to raise the cash, then the price of Bitcoin will go lower, and then they'll be margin called on their debt more or have to sell more Bitcoin to raise more cash, things of that nature. And it goes from an infinite money glitch of issue debt to buy Bitcoin, an infinite money glitch on the way up, and a doom loop of margin calls on the way down. And so I think the tangent I went on is why I think Coinbase strategy and Bitcoin as a whole have at least one more large leg down, because usually in a Bitcoin bear market or a crypto winter, we see some firms that overextend themselves on leverage, get margin called and blown up essentially, like FTX in the last cycle, or Terra Luna, and frauds like that just get caught out, people doing shady stuff. And I think overall the hype for crypto's gone away. It's lost its newness. All the people that were excited about crypto and Bitcoin have moved on to AI. All the former Bitcoin miners are now data center operators. All the NFT bros are now AI bros. And AI is so awesome. And so all the hype around Bitcoin, it's kind of like Facebook was the cool thing when it first came out, and then your grandparents got on Facebook, and now it's not the cool thing anymore. And that seems to me what Bitcoin has done. The only thing that's popped in this last halving cycle was shitcoins and meme coins, pump and dumps, not any actual altcoins pretending to do real things. It was all blatant pump and dumps that everybody knew was a pump and dump, but they were just trying to be the ones not holding any bags. So with that being said, I say that as someone who thinks that the crypto innovations and the alternative to the fiat currency, I'm a big proponent of that. I just watch these cycles. So with that being said, I had someone wanted me to go over banks. So I think it would be fun to talk about Fifth Third, if I could spell fifth. There it is. I can spell. Alright, we got kind of a choppy earnings history. Usually you can just kind of write off COVID, but we had some down cycles. They just did an acquisition of Comerica Bank, and that's just been finalized. So they've historically been traded at a much lower multiple than what fair value is, but we see them creeping up over that. Last time we really saw that was 2020 to 2021. Then we had the regional bank crisis of 2022. It really fell during that. Earnings were dipping. Then now we see a period of exuberance. So we see this orange line creeping up pretty good, thinking that earnings are going to be pretty good going forward. So if we take a look, just go to forecasting. So for whatever reason, we're going to get a massive 64% earnings jump in 2027. That's, I don't know where that's coming from, but that's a big jump. I wonder if anybody knows how these analysts come up with this number. I would love to learn some more things, but for now all I can do is look at that number. You'd feel like banks would be a pretty, let's just see how well the analysts do. So at current, they beat half the time and miss half the time, and 1 year out with 10% margin, they usually beat or hit, and then 2 years out within, I mean, 20% margin is a pretty big margin though, but they usually beat it. So, well, I say usually, they beat it 36% of the time and hit 45% of the time. So they offer a nice little 3% dividend, and so if we look at, I want to look at, there's no way it's going to be valued at 21 times, just because we saw that it usually doesn't even have a premium. It has a less than premium. So we just, if the earnings stay the same, but it trades at its typical lower multiple, you're still looking, I mean, 9.3% year over year. You'd really like to see it get up to the 15 multiple, but the market hasn't rewarded it like that usually. If it ever got up to that, you'd be looking at 20%. So I think this bank looks okay. Like I said in the first episode, banks are kind of, it's not, there's a lot of, the people that trade banks don't quite look at earnings like this, and that's why they get a different multiple on their earnings. They look at other metrics, and I'm not that familiar with trading banks, so I don't try to pretend what I don't know. But someone wanted to see the fast graphs of banks. You can check out JP Morgan. I'm sure they have a premium associated with them. I guess not. So the 12 PE, they've crept up above 12 and right at that 15 line. Usually we see that just out of 2020, just like last time, and then 2022 with the regional banking crisis, we saw banks take a hit. But this is a nice earnings curve. I would say JP Morgan's like the premier bank. Like it's trading right on the 15 multiple. If it stayed there, you're looking at a 9%, just like Fifth Third. If you look at a normal multiple, you're looking at 2.5% per year. Not exactly what you're looking for. A lot less dividend than Fifth Third, about half. And a lot better 2 years out, but 20% is a pretty big margin for error. So with that being said, seems like Fifth Third might be better positioned than JP Morgan, but JP Morgan is the premier bank in the industry. Let's see, what else did I want to look at today? I think with that being said, I keep saying with that being said, nobody said anything but me. Let's take a tangent and go to Finviz and look at our screener and see if we can't find some more fun stuff to look at. I mean to do a follow-up because there was some fun stuff we looked at last week where the fast graphs looked interesting, but I didn't quite do a ton of research to find out what they do. So Finviz, if you weren't here last week, this is where I like to come up with ideas. So finviz.com. They also don't sponsor me, but if they would like to, I would love to get any sponsorship deal. Me and my 20 viewers, but we'll keep that in mind. So when I'm looking, so I said this in the first episode, I'm looking to try to get 15 to 20% year over year, which is a solid return rate. I know everyone's going to say S&P 500 beats that, but not over the long run, and it's all about what kind of risk you're exposing yourself to get that return. So if I'm buying companies that have been beaten down into the dirt and have solid earnings to fall back on, who's how low can it really go kind of company, then my margin of safety is a lot higher. So where I was going with this was selecting a market cap to look at. If I'm trying to grow 15 to 20%, I need smaller companies grow their earnings at percentage-wise a faster or bigger clip than the larger companies, because to grow, if you have say you have $1 billion market cap, you only have to grow by 200 million in value to grow 20%. Whereas if you're $1 trillion market cap, you have to grow by 200 billion to grow by 20%. And with that, so just the law of large numbers, it's easier for smaller companies to scale at percentage-wise in order to be good investments to meet my goal. And my investment thesis is that investment returns follows earnings and dividends, essentially. So if Finviz wants to stop being slow and let me use it, I will show you guys how I normally look up stuff. I think last week we had a good time looking up. We looked at ACOM, a few other. We looked at a few other chemical commodity companies, an agricultural company. All right, Finviz does not want to work today. You know, I have Frontier's internet with 2 gigabytes. It might be my computer, not my internet, but we'll see. We might not be looking at the screener today. Let's just do under 10 billion. Okay. Come on, Finviz. You know, I was talking how good Finviz is. I was talking them up, and now they're just proving me wrong. Let's look at a company. Let's see if we can find one with a positive dividend that's under $10 billion. if Finviz wants to work, we might have to scrap this idea if it's not working, but we're doing it live. So I only look at U.S. companies because U.S. dominance, and I'm an American, so that's the best. To me, that's where all the best companies are. So also, while we're kind of waiting for this to load, I want to say Happy Father's Day to all the fathers out there. Have fun with your family, enjoy, eat lots of food at your cookout, lots of desserts. I had a really nice Father's Day. I got to spend it with my family. It was great. Okay, so when we got that, let's look up some fundamentals now. So we got a list. We got a list of 72 pages of companies with this so far. So we're going to look up forward PE because that's forward looking. And we want to do under 20 with growth rate for the next 5 years. Just look over 5%. That should give us a lot of stuff to look at. So I don't really want to look at auto parts because I don't like the business. I guess I can look at auto parts, but it says 83 PE. Their future PE must be. That's what we filtered by. We could filter by market cap actually. We looked at ACOM last week. That looked like a pretty interesting company. I'll have to come back. Maybe I'll do some further research on them. So we'll start closer to 10 billion. So I'm not looking for credit services. Donaldson, Special Industrial Machinery, DCI. So if anybody has any information on these companies that we talk about and wants to help shed some more specificity into what they do or what their outlook is, that would be awesome. Share in the comments below. Alright, so we got, historically, we got trades at a premium usually. Usually it gets assigned like a 24 PE on average. Seen a little dip lately. There's been a few times where it's come close to that orange line, but it never really touched the orange line. They have a little dividend, 1.5%. We said they were close to that $10 billion market cap. So forecasting, we see that it's trading at that premium. So if you did get multiple shrinkage to 15%, you would not be making your money. So you'd have to be holding on to that 22% or 22 PE or 20 PE, whatever we said, from that long-term average. And even then, you're only really looking at 10%. So this company, I wouldn't do any further digging on just because they don't meet that first visual pass to get to 15%. So I really use FAST Graphs. I use Finviz to come up with the names. I use FAST Graphs to do the fast screening. If it passes FAST Graph screening, then I really want to dig into the numbers and make sure that really understand the business from like I'm going to own the business essentially. Essentially, who gives the money and for what, and why is that going to continue, and what are their avenues of growth? And would I want to own that? So we're going to look up OGE is another company that was on the list. It says a regulated utility company. So maybe my 20 forward PE was a little high, or my growth rate was a little low. So we only have a 3.59% dividend. As we can see, it's above the blue line and the orange line, so its forecasting is probably not going to be that good. With interest rates rising, that's going to drive utility companies' price down to increase the yield because they're going to be competing with bonds for because bonds offer yield and these utilities are like an alternative for that. That'll be a REIT. We're not looking at banks or REITs. Let's see. Acuity, electrical equipment and parts. Maybe we found the next AI picks and shovels. So, 1 second, stream. Alright, I'm going to have to end the stream. My wife is calling me. So,